Hello, this is J. Mike Perkins. I've been a mortgage loan officer and a credit counselor for a long period of time, and I have helped literally thousands of prospective home buyers that have had some kind of credit problem in the past that are now trying to reestablish their credit, boost their credit scores, and qualify for a mortgage. If that applies to you, don't make one of these 5 mistakes reestablishing your credit. Mistake number 1 is to live in the past and not establish new positive credit. The most important factor in determining your credit score by far is your recent payment history on your active open credit. That counts more than anything. So before you even think about trying to deal with any item from the past that's on your credit report, be absolutely certain that you have between 2 and 3 sources of active open credit that are reporting positive payment information right now. And in most cases, at least one of those needs to be a credit card that reports as revolving credit. If you'll just do that and pay it on time for 4, 5, or 6 months, odds are that will do more to boost your credit score than anything you could possibly do with the past information on your credit report. If all you've got on your credit report is old stuff that's bad, there's just no way that that's going to get you a positive credit score. There's no way to turn bad credit from the past into good credit. You've got to go and establish that right now and pay it on time. Mistake number 2 is excessive fear of credit inquiries. I hear this a lot. I'm afraid to go and open up a credit card because they're going to check my credit and I've been told that inquiries are bad. Well, first of all, it's not true that every inquiry lowers everyone's credit score all of the time. That only applies if the formulas in the credit scoring decide that you have quote unquote too many recent inquiries. Now, unfortunately, the formula to deciding how many is too many recent inquiries is complicated. It's not just a set number in a certain period of time. It depends on the timing of the inquiries, and it also depends on what type of inquiry they were. But you shouldn't just assume that you've had too many recent inquiries. But even if you have, every additional inquiry will only lower your credit score somewhere between 3 and 5 points. So it's not the score-killing thing that most people believe. And although a mortgage lender will check all 3 credit bureaus, Equifax, Experian, and TransUnion, most creditors, including most credit card companies, will only do an inquiry on one of the 3 bureaus. So if you apply at one company and they check Equifax, well, maybe that'll lower your Equifax score a few points, but it won't affect your Experian or your TransUnion score. And there's a good chance that the next creditor you apply with will use Experian or TransUnion. And finally, you need to remember that if you are successful and you open up new credit and if you pay it on time, then you're going to gain way more in your credit score than you could ever lose from the inquiry to establish that credit. Mistake number 3 is lack of recent revolving account information. Credit comes in different types. One type of credit is called an installment loan. And with an installment loan, that's something like a car loan, where you borrow all the money up front and then you make fixed monthly payments. And it's coded that way on the credit report as an installment loan. Another type of credit is called revolving. And revolving typically refers to a credit card. And of course, the payments go up and down as the balance goes up and down. The way that the credit score formulas are written, they want you to have some recent revolving credit on your credit report. And if you don't, they take points off your credit score for not having recent revolving account information. This is important. Let's say that you need to raise your credit score 30, 40, 50 points, and you're trying to do it in 6 months. If this message applies to you, lack of recent revolving credit information, then you're basically going to have to open up a credit card to get there. Because when I model this in the credit score simulation software, and once again, I'm talking about someone that has lack of recent revolving account information, and they need a big boost in their score. If they go and open up a credit card, now every situation is different, but just in general, if they go and open up a credit card, it might be possible to get that 50-point boost in 4, 5, 6 months. But at that same scenario, if they don't go and open up a credit card, and they just depend on installment loans to give them that boost in their credit score. It could easily take them 1.5 to 2 years to get that 40 or 50 points. So if you need to raise your credit score quickly and this message applies to you, lack of recent revolving account information, then you're going to have to open up a credit card. Now, I'm no fan of credit cards. They've caused me problems in my own life, but this is just the way that the system works. Mistake number 4 is opening up a prepaid debit card that is not revolving credit. Recently, there have been several companies that have found a way to take a prepaid debit card and have that show up on your credit report. But the problem is the prepaid debit card does not show up as revolving credit. It shows up as a type of installment loan called an open loan, where there's one payment that pays the balance off in full. Now, that's not going to lower your credit score to have one of those on your report. But if your problem is lack of recent revolving account information, it's not going to help you. There are 2 ways for you to spot the difference between an actual credit card that will report as revolving credit and one of these prepaid debit cards that will not report as revolving credit. First of all, a real credit card that's going to report as revolving credit, as far as I know, every one of them is going to check your credit and do an inquiry. It'll probably be on one bureau, but they'll do it. The prepaid debit cards scream at you in their advertising, no credit check. Okay, that's a big red flag. Once again, if your problem is lack of recent revolving account information, that will not help you getting one of those. Secondly, is how do they handle your monthly payment? If you get a secured credit card from, say, Capital One or somebody like that, and it's a real credit card that reports as revolving credit, they're going to hang on to your security deposit. If they want $250 or $300 up front, they're going to hang on to that. If you go and charge $50, you're going to get a bill for $50, and you have to pay that bill. They don't pay it out of your $300. However, on a prepaid debit card, they do. So if you have $300 and you charge at $50, now you got $250 left because it's not a real credit card. It does not show up as revolving credit. And once again, it won't hurt you, but it won't help you solve the problem if your problem is lack of recent revolving account information. Mistake number 5 is getting late payments and maxing out your credit cards. About the worst thing you can do when you're trying to establish new positive credit is to pay it late. I strongly recommend that you set up an automated payment on all of your brand new credit that at least pays the minimum due. You can always make an additional payment yourself on any one of those accounts that month if you want to. But if you do this, at least it will never be reported as late. And finally, if you know that you're going to buy a house or a car or something like that and they're going to do an inquiry on your credit report, you want to try to pay all of your credit cards down to about 30% of the credit limit or less if possible. If you do that, you'll boost your credit score. You also need to remember, though, that it may take 30 days for that information to show up, so you need to do it about 30 days before you apply for the new loan. I hope these tips have been useful to you. I'm J. Mike Perkins.